The stock market has been selling off pretty hard recently. The S&P 500 went through 4 consecutive down weeks, and it even traded in and out of correction territory. But, almost like clockwork, when the market drops, investors seek an opportunity to buy the dip. But timing the market is difficult. So does this strategy actually work? Let's look at what past market dips tell us. Buy the dip is one of those Wall Street idioms that people like to say, like buy low and sell high, be greedy when others are fearful, and fearful when others are greedy. But essentially it means that when there's a big market sell-off, whether it's a single stock or the entire market, you step in and buy when things are cheap. It's a risky move, but it has logic. Retail investors tend to invest in companies that they know. So suppose that you believe a company like Apple isn't going anywhere, and you're willing to buy the shares at any price point. Then all of a sudden, you see that the stock has fallen 30%. You don't think, should I exit now because it's on a downward trajectory? You think, great, it's cheaper. This is something called dollar cost averaging, which works like this. Say you buy 10 shares of a company at $100. It drops to $50, so you buy 10 more shares. Suddenly, your average purchase price went from $100 to $75. Then, if it goes back up to $80, you're still net positive. Retail investors tend to buy the dip pretty reliably, including during recent market sell-offs. Let's look at some of these examples. Dip buying is often tied to a news event. Last August, when the July jobs report came out, people thought there was going to be a recession coming, and markets crashed. Let's look at this chart that combines retail investor buying data from Vanda Research and the price movement of the S&P 500. This will show us how retail investors responded to that market drop. The index dropped by around 3% from its previous high, but there was a big uptick in investor buying. The next day, the stock fell an additional 3%, totaling around 6% below the previous high. But retail buying decreased, indicating that investors may have used up their reserves and couldn't keep buying the dip. You often see these buy the dip spikes right away. Then it takes some time until retail investors have another buildup of cash to step in again. So timing really matters. Beyond broad market sell-offs, this also happens with specific stocks. Last year, CrowdStrike had an outage on July 19th, and its stock plummeted, falling around 19% from the previous high. Meanwhile, there was a huge uptick in retail investor buying. Looking back, this may have worked in their favor. By the end of January, CrowdStrike's share price was back up to its all-time highs. However, there are other examples where the rewards for buying the dip are yet to be seen. In January, Chinese startup DeepSeek announced an AI model that was developed at a fraction of the cost of major industry players. This triggered a massive tech sell-off and Nvidia's stock crashed. There was a jump in retail buying volume on the day the stock fell, and Nvidia recovered a little bit over the following weeks before falling to new lows, which triggered even more dip buying. So it's hard to say if buying the dip will have worked in the investor's favor. It all depends on when they sell. Dip buying isn't a perfect strategy because it requires an element of timing the market, which can be really hard to pull off. It also requires investors to have some money saved on the side to put into the market when it dips. But not every investor has money saved to invest at all times. And leaving some investable money on the sidelines to wait for a dip could mean you miss out on rallies. It can also be hard to know the right dip to buy. Warren Pies of 314 Research analyzed 128 instances when the S&P 500 dipped by 5% or more from its rolling 3-month high. He found that most of the time, investors who bought the dip gained quickly, but more than 40% of those dips turned into a correction or something even more serious. This is why it works best for retail investors with a long-term investing strategy, or time horizon. If you buy stocks that crash 20% on a day and then hold it for years, you have more room for improvement. But if you're trying to flip it sooner, there's more pressure to time it right.